Hello everyone and welcome to our weekly course. Today we will talk about Greeks. So Greeks are the risk parameters when it comes to trade options, and these risk parameters are so important, and it's mandatory to understand them very well in order to make let's say a good trade, well, in order to optimize the potential risk, to control it to the minimum, and in order to increase the potential profits from the strategy. Of course, the Greeks are risk parameters. Here we will talk about four risk parameters. In general, we have more. We have five Greeks, but the fifth one, we never talk about it because it's related to interest rates. And as interest rates are so low, near zero, they are the role, the Greek related to interest rates will never be something important. We will talk about the delta, we will talk about the gamma, we will talk about the theta and the vega. Each parameter will cover a risk that, of course, the option will face during its life before the expiry date, and we will see how every Greek parameter, every risk parameter moves and interact with the other Greek. Yes, because the Greeks, they will interact between each other, and it's so important to know how this works. Well, we will see some definitions. Of course, most of you know maybe about the definitions, maybe about the mechanism of these Greeks. We will review that together, and I will show you some examples on my platform, Interactive Brokers. First, we will talk about the Vega. In fact, the Vega is related to the implied volatility. So implied volatility is the measure of the risk and also the likely movements that the stock can do to the upside or to the downside. Here, in fact, in mathematics, we call this the standard error. In fact, it's the variation around, it's the variation around, people are joining, it's the variation around the average. Okay, for example, we have a class with students. For example, we have 10 students, and all these students make, for example, 10 out of 10 as marks, 10 out of 10, or let's say 15 out of 20 to make a clear example. So 15 marks, okay? So all of them, the 10 students, obtain 15, okay, out of 20. So the average of the class is, of course, 15. What is the standard error? The standard error here is the variation around the average, where we don't have any standard error. It's zero. Why? Because all these students had 15. So it's not a volatile classroom. All these students are making the same results. So they all had 15. So there is no standard error. Okay, in French we call this écart type. So this is the volatility. Volatility is how, in fact, the stock will move around the average. Okay, if we have another class with 10 students, 5 will obtain 20 out from 20. They are brilliant, so 20 marks. And the 5 others will obtain 10. They are just not as brilliant as the other 5 students. What will be the average? If you take the calculator, it will be 15 because we have 5 below 15 and 5 above 15. So here, what is the average? It's 15, but do we have a standard error? Yes. As I told you, the standard error in statistics and in probabilities, it's the variation around the average. Here, the variation is 5 points. because we have 5 points. The result went up to 5 points up above the average, because 20 minus 15 is 5, and 5 points below 15. So it has a standard error, a volatility. This class, this group of students is so volatile. In fact, people are making brilliant results, but others no. Although, despite the fact that we have the same average compared to the first class, 15, 15, but one is not volatile, is stable, and the other one is so volatile. So this volatility, when we talk about implied volatility, 1% implied volatility means a possible or a likely movement to the up or to the down, because the standard error is always a positive number. And this in absolute value, the absolute value in mathematics, sorry, I'm giving you some mathematical elements. An absolute value, when I say the absolute value of 3, it can be 3 or minus 3. So the 1% implied volatility, that can be 1% up or minus percent. So the minus percent will be the movement to the downside. So the impact of this implied volatility will be measured by the Vega. That's why it's so important when we trade options to choose the right implied volatility. When we buy options, we buy a low implied volatility. Why? Because trading options is trading implied volatility. When we say here implied, it means turn it to the future. It means that it will be measured and expected. This is an expectation of the future volatility. The most important index in terms of volatility in the world is the fear index, and it's called the VIX. The VIX, yes, it's a volatility index, and this will measure the volatility of the S&P, the SPX 500 over the 30 future or the 30 next coming days over 1 month. With the implied volatility, it can be expected over 1 month, 2 months, and so on. Okay, so what will be the impact of the implied volatility? We said that when we trade options, we trade implied volatility level. Why? Because what will make the price of the option expensive or not? Because overall, what we trade is the price of the option. We will never take the risk to let the option expire, because you don't know what will happen. The 90% of time you will buy the option, we'll need the stock to go into our direction in order to see the premium we paid for the option going higher. Like that, we can make a profit. For the call, we need the stock to go up. For the put, we need the stock to go down. So like that, the option will become more expensive and we can sell it for a higher price. So here, why the implied volatility will be so important? Because when we trade options, we trade the probability to make profit. An option price will depend on this probability. If the option has a high probability to make profits, the call option or the put option will be expensive. If it has low probability to make profits, of course, it will not be some interesting and it will be cheap. Well, I didn't reply yet to the question. How can we use the implied volatility, and how can we use it? We know that we buy the low implied volatility and we sell options with high implied volatility, but I need you to understand why, the logic behind that. In fact, the probability to make profits for an option is the probability to get in the money. In the money. What is the in the money zone for the call? Always keep in mind that in the money is where we make profits, and for the call, we need the stock to go above the strike. Like that, with the definition, the call gives the right to buy 100 shares at the strike. So in the money zone will be above the strike. For the put, it will be the opposite, because with the put, we need the stock to drop. So the in the money zone will be when the stock price is below the strike. Okay, so here we'll make the link between high implied volatility, expensive price, and the probability to get in the money. Please follow. If the implied volatility is high, remember the example I give you with the volatile classmates, the group of students. We saw that the group of students, they had the second group, they have an average of the classroom is 15, but the 50% is getting 20, and the 50 other percent are getting 10. So the remarks go to 10, then goes to down to 20 for the top side, and go down to 10. So we have a volatile group. So for a stock, if the volatility is high, it means that it can jump up or down in a huge movement. Implied volatility is the expected movements according to some volatility models. We can talk about Gauss, Monte Carlo. These are so advanced, but here I need you just to understand the logic. High implied volatility, unexpected high movement from the price is expected from the market. Unexpected high movement, what does it mean? It means that the call, for example, we take the example of the call has more probability or higher probability to get in the money. Getting in the money equal high probability to make profits. That's why the contracts will be so expensive. Here will tell me, okay, but what about the puts? Remember, implied volatility is the standard error. Here we talk about the absolute value. The implied volatility means that the stock can go up or down. And as our scenario is included in that measure, that's why the options, calls and puts, both, they will be expensive. This is the logic behind why all the time we say that we find that expensive or high implied volatility means expensive options. And why should we sell options instead of buying options when the implied volatility is high? Well, the logic behind buying anything in the world is to buy low and to sell high. Like anything, like Forex, like crypto, you will not, of course, even if the Bitcoin was at 65,000, it was just silly movements or decision to buy Bitcoin at 65. Even if everyone was seeing the Bitcoin going to $1,000 within 2 days, never buy because people say that it will spike or it will drop. Always refer to the fundamentals, and here I'm talking about the fundamentals. It's not the fundamentals, the fundamental analysis, the earning per share, and so no, the risk parameters. That's why Greeks are extremely important. So when the implied volatility is high, especially when it's near the maximum ever, the highest ever, this situation will let us know that the price of the option is overpriced. It's a bubble. It will drop because an implied volatility cannot all the time go up and cannot all the time go down. When we are near the maximum, the highest ever, here the implied volatility will be set to drop. That's why if the implied volatility drops, the price of the call or the put, whatever the option, will drop. So if you buy it at an expensive price, you will just lose. And this happened for me one time. I was so enthusiastic with the movement because the technical analysis and all the news about Baidu, it was a Chinese stock. I had a great selling bearish signal. I bought the puts, of course, because when we think that the stock will drop, we buy the puts to play the sell-off. Well, the stock just 2 days later dropped a lot, like minus 10% or minus 15%. I remember I have bought the put when the stock was at 140. It went down to 120 after 2 days. Well, here we should be just so happy because the put should be making a lot of money. Well, I was losing. Why? Because it was something like that. Let me share with you. Yes, up. It was something like that. This is my volatility lab where I analyze the volatility and so on. Here today we will talk about the implied volatility. This is skew, but of course that example, I think 8 months ago or something like that. No, not 8 months, maybe. Yes, maybe 8 months. It was like that. In fact, I bought the put exactly something here. And boom, just drop it. And with a crash in implied volatility like that, even if you get it right with the direction, well, it doesn't mean anything because I bought an overpriced a bubble in terms of premium. So when the implied volatility dropped, that's in fact interaction between the adjustment in terms of volatility and the direction, that was not enough to make me profit. Well, at the end, it went down to 115 and they made at least only $100 while I could have made maybe $1,000 from that movement. Just to give you an, an outlook and an explanation about the importance of the timing in terms of implied volatility. Here you will tell me, well, we have the signal to sell. What should we do? We sell, we buy the put or not? Well, no. That's why it's interesting to know about all the strategies, because at that moment, here, for example, see here square, that was only 5 days ago. You can see that even when the stock market dropped, square, the usually when the stock market drops, the implied volatility spikes. Here it was the opposite. First, why? In that moment here, it was just after the earnings. Keep in mind the crash of implied volatility just after the earnings. That's why the arbitrage in terms of implied volatility is so important. And what is the arbitrage? The arbitrage is to search for the overpriced and the underpriced implied volatilities, okay, between strikes, because the strikes, each strike will be different in terms of implied volatility with calls and puts, calls with the same expiry dates, calls with different expiry dates, and puts and calls with different expiry dates. It's just a complicated universe. But anyway, I try to give you the simple way to understand how these Greeks, in fact, the Greeks are options, work. So here, what should we do instead of buying a put? What is the simple strategy that will give us, let's say, not the same result in terms of profits, but will take benefits from the high overpriced price due to the high implied volatility, and at the same will make profits if the implied volatility drops and make profits if the stock drops. Instead of buying a put, we will sell a call. That is the difference when we decide to buy a call or to sell a put. Buying a call and sell a put, both are bullish strategies. Both make profits if the stock goes up. Buying a put and selling a call, both are the same strategies in terms of direction, but not the same in terms of risk profile and in terms of profits. You know the difference. So what will decide is the implied volatility. That's why trading options is equal to trading implied volatility. And the same here, you can see that the implied volatility is going up. That's why our new strategy is doing well, because even with the crash, the implied volatility is offsetting that crash, making our options more expensive. And that's why we are not losing. Okay. So buying options is buying low implied volatility. Low implied volatility equal to cheap, in terms of implied volatility, cheap prices. And if the implied volatility will go up, that means that the premium will go up. And here you will tell me, what should we do? Low implied volatility, never and never sell options. Because once the implied volatility will go up, you as seller, you want the price to drop. That will not happen. It will go up and it will make your position losing. Okay, so this is the part of implied volatility. For the Vega, we talked about the Vega. The Vega measures the impact of a change of 1% on the option price. Here, all what you need is to analyze the implied volatility. You will tell me, how can we know if the implied volatility is low or not? Compare it to the past. Here, the lowest ever is 46%. So relatively, if the implied volatility is between 40%, 45%, it's a cheap one. If it's above 60%, you can see here's the maximum is 60%. So it's an expensive one, just according to the past. The market repeats itself. Market has memory. Okay, so this is the part of implied volatility. Theta. The theta is the biggest problem in terms of options buying. When we buy options, of course, we have an unlimited potential profit. You buy a call, the stock goes up, the more you are making, the more the stock is going up, the more you are making profit. Perfect. But you will not be able to catch this perfect timing all the time. That's why we have sellers. In terms of probabilities, a buyer of an option, for example, for a call, a buyer of a call, he wants the stock to go up in order to make profits. In terms of probabilities, let's say we will talk about the cases we have for the stock. The stock can either, one, go up, two, stay sideways, so rangy, doesn't move, three, drops. We don't have another case, up, sideways, or drops. For a buyer of a call, he will make profits only in one case, in one case, if the stock goes up. That's all. So out of three, some elementary probabilities, out of three cases, we have only one case where the buyer make profits. So the probability is 1/3, 33%. Okay, for the seller of a call, he has more than one case. He has at least two cases. He makes profits if the stock drops. He makes profits if the stock stays sideways. So in terms of probability, we have two cases out of three, so 66% chance to make profit. Of course, that this doesn't mean that you should just close your eyes and you sell. No. The right moment, implied volatility, and we sell when we have the signal from the charts. We sell a call when we see that the stock market is overpriced. The valuation of the stocks is just huge. For example, what's happened last time. And you saw that we sold calls and we were right. We will sell put when we see that the stock hit the ground, found a bottom, and it starts to recover. According to the implied volatility, we will choose these stocks that have high implied volatility. Okay, so the sellers will be interested in the theta because when we buy options, we have a low probability to make profits, plus the commission we are paying every day to the seller in terms of time decay. Well, that means that if the stock doesn't go immediately or during the first or the 2 days, we will see our position losing. And this will be good for the seller because he will receive the theta. What is the theta? The theta is a portion of the premium we pay as buyers every day. This is the only motivation for the seller because the maximum profit that the seller can receive is the credit from the premium. Why we should, another thing, why should we sell high implied volatility? Remember, high implied volatility is equal to expensive price, expensive premium, expensive option price. And what is the theta? The theta is a portion of this premium. So expensive price, theta is a portion of this expensive price, so a high theta. The maximum the seller can receive is this theta, so it's better to receive an expensive thing. That's why everything is linked. Implied volatility, the direction, and so on. Okay, perfect. But how the implied volatility, how this theta time decay moves? Here, I will show you a graph. I'm not sure if it's so clear, but I will explain to you. We said that we said that the theta is a portion of this option value. Option value is the price. High price, the theta will be high, so it will be interesting for the seller and even for the break even. For the break even, it will be interesting to see a far break even.
Market data connection reestablished.
Okay, we understood. Okay, so here the option value will start. For example, here you see how many days are remaining till the expiry date. You see here, this is the movement of the time decay of the theta. This option value will be losing at a normal, let's say, speed. Okay, but the most important thing is during the last 1 month, and especially during the last 2 weeks, the time value will decay so fast. Why? Because the theta is significant, is big, is high in terms of value during the last 3 to 2 weeks of the expiry date. So the short-term expiry dates will decay so fast. That's why we always go for 1 month or less than 1 month, 3 weeks in terms of selling options. Because first we optimize our entry with an expensive, an overpriced price due to the implied volatility. Plus we need that time decay, that theta, to accelerate the drop for the option value. That's why we go for 1 month or 3 weeks and below 3 weeks. Okay, it's so important because sometimes some will just scalp and will hold the scalp. So they will just go for 1 week expiry date. They will just hold the strategy, and the following day it's already lost 70% of its value, while the stock market didn't move. It's normal because during the last week you will see that the theta will just kill your position. Okay. Now, that's why it's important to know in terms of your horizon, trading horizon, trading time, the time you want to hold the strategy for, what's the expiry date to take. If you are scalper, here I'm talking about people who will trade during the same day and they are sure to close during the same day. The theta, the expiry dates, you can go for a short term. Here you have 50% chance to make profits and 50% chance to lose everything. But as the short-term expiry date is, let's say, is expensive in terms of theta, the theta is so high, this will be offset a little bit by the price. The price will be cheap. Why cheap? Because you have only 1 week. You have less probability, a low probability to make profit. So that's why trading options is trading implied volatility. But if you want to go for a swing, the best is to go for 1 month to 1 month and a half till 2 months, because you will have enough time. Everything can happen. It's not guaranteed, but in terms of probability, you have enough time. 1 month to 1 month and a half will have,
Connection reestablished.
okay, we'll have an acceptable theta here. Of course, you need also to get that entry, the best entry timing. So in terms of lowering and controlling the risk, because even if you get the right entry, nothing will prevent the market from dropping. Here I'm talking about the call. So you go for 1 month. So like that, even if it drops, you still have a probability that it can recover, especially if you go and you catch a low implied volatility. So you maximize the probability on your side in order to make profit. Okay, so this is the theta. For the theta, again, we should know that the strikes near at the money level will have the maximum of theta. For example, here is an option chain of square. The stock now is at 220. So the at the money, always at the money, is when the stock price is equal or near the strike. In terms of delta, it will have around 50%. So here, the one, it will be this one. For example, just an example, June 11th, 220. You can see that the theta here, 27, and this is the maximum. Then if you increase the strikes, you see that the theta will decrease. Okay. And if you lower the strike, you go away, in fact, from the at the money, it will the same, it will decrease. So the theta will be at maximum with strikes at the money. So that's why it's risky to trade exactly out of the money. Either you go for a little bit out of the money or a little bit in the money. Well, in the money, it will have a higher delta. So higher delta, it has also a high probability to lose, because the delta, we will see, that is the amount of the profit you can make, and also the amount of the loss you can make per a change of $1. So the theta is at maximum. For example, if I go for the 220 call, I will add it here. So here I have the theta, and I compare it to the one expiring, for example, after 2 weeks, 220. You see here that the one expiring on June has $20. Here it means that every passing day we are losing $20 minus 0.20. So minus 0.20 multiplied by 100, because one option is set on 100 on 100 shares. So $20, and the one expiring after 2 weeks, it has more theta. It has $29. In fact, remember that here we have a low implied volatility, as I showed you. But if we have high implied volatility, you will see these theta at a so high level. And the difference, it will be so high as well. So that's why everything is linked. I will try, for example, Tesla maybe, and I will compare the same. 615 minus 2%. So if I go for June, for example, this is 670, just an example, and we will compare the same contract with the same strike, but at different expiry dates. And years one, for example, May 21st, 670. Okay. So here we can see that the one expiring on June 18th has $55. Okay, $55 risk in terms of time decay. And the one expiring after 10 days, it has almost the double, $82. So short-term expiry date will have high theta, especially if the implied volatility is high. Here it's a huge danger. Okay, so this is the theta. Now the delta. Here we have the delta. So the delta is the amount of the profits or the, let's say, the amount of the profits or the loss that an option can make with each dollar up or down from the stock price. Here, for example, I have, this one is May. Let's stay with May. Here I have 0.20. The delta is 0.20. Okay. So if the stock goes up from 615.75 with $1 up, 616.75, here we have a change of $1 up, we will be making $20. This is the delta. We are making $20. And of course, a higher delta will have a higher profits rates, let's say, but also $1 down from 615 to 614. Here we are making a loss of $20. If you go for a 65 delta, we will be making $65 loss. Okay, we should know about something so important. The delta has its own theta. It has its own time decay. We call this the bleeding factor. What is this bleeding factor? If the stock goes up and down, for example, here, for example, for 1 hour, the stock goes up to 620, then it goes down to 613, then 17, then 10, so around 615. Up and down, up and down. This movement will make the delta bleeding. The 0.20 will become 0.15. The delta has its own theta, and this theta comes from the principal theta. Theta is time. And if the stock doesn't take one direction, you will see that the delta will decrease. We call this the bleeding factor. That's why the up and down, the rangy stock in a general outlook is not good for buying, because this delta will decrease. And when we say the decrease in delta, it means that the loss we are making plus the theta every day. Okay, so these are the interaction between the theta and the delta, the theta and the volatility. You see here, everything is linked. For the sell, people are interested in selling options. The delta will be also the probability of the buyer to get in the money. So here, if we buy this call, here it means that we have 20% chance to get in the money. So if we want to sell options, first we said we select a high implied volatility because the theta will be important. We are sellers, we are theta players. Then we select that time expiry date where the contract, the option contract, will decay more because the theta is accelerating enough during the last 3 weeks till 1 month before the expiry date. And the other thing, we should select, of course, measure resistance, measure support, but also we must select a low delta like that. Here, the buyer has 20% to make profits, but has 80% chance to make a loss. The loss of the buyer is our profits as sellers. So like that, you maximize all the probabilities on your end in order to make profit. It doesn't mean that it will be guaranteed, but overall, over 100 trades, you will get, for example, 80 good ones or 90 good ones. Okay, so this is in general how to understand the Greeks. Last thing, for the delta, of course, the delta changes as well. The delta has its own delta. If the delta is how the option price change according to the change of the stock price, the delta has its own delta. We call this the second derivative, and we call this the gamma. You see here the gamma. It means that, for example, here 0.005, here it means that if the stock goes up with $1, this 0.00005 will be added to 0.22. So the delta will become 0.225. That's why the more the stock goes up, the more the delta will increase till it becomes 1 and it will never exceed 1. Why? Because a probability can only move between 0 and 1%. That's why here it's 100% because it's deep in the money. Here we have almost 100% to make profit. This gamma is so important because here it means that if the gamma is high, it means that the delta is likely to change very fast. So if the stock goes up and we are sure for example, we take that situation, the stock here goes for example, tomorrow goes from 616 to 650. Of course, we buy a call. The profits made from this contract expiring after 10 days will be way more from the profits made from the same strike expiring after 24 days. And this will be also it's in French, also way more from the profits made from the same strike expiring after 3 months. Why? Because short-term expiry dates will have sure the high theta, but also high gamma. So if you get it right in terms of direction, the delta will turn from 0.20 to 0.30 immediately, to 0.30 to 0.50 so fast. But the same strike expiring after 2 months will take more time, needs more movements from the stock price to turn from 0.20 to 0.30. So it's so important to know the relationship between the delta, the gamma, the theta, and the vega. Okay, I hope that it was clear for you. Of course, it needs a lot of practice, but this is the main things you need to know. You don't need to know anything else.